For more on the markets right now, we want to bring in Brenda Vingiello, who is Hill Global Advisors Chief Investment Officer. She's also a CNBC contributor. And Brenda, what do you think about that? Is this something that the markets are likely to trend higher in November and December? And will volatility go up?
I think between now and then, we have a fair amount to get through, right? We have another really big week of earnings next week with a lot of the large cap tech names reporting. We have the election and we have a Fed meeting. But I think as soon as we're finished with all of that, and especially the election, I think that should pave the way for the market to appreciate into the last part of the year, especially after that uncertainty goes away. But admittedly, I think the market has held up really well given the uncertainty of the election. I think there was a lot of expectation that maybe we would see more volatility than we have. But I think a lot of that we haven't seen a lot of that because we've seen such great fundamentals from the economy and so far from the earnings cycle here.
Right. We've seen great earnings numbers. We've seen great numbers when it comes to the economy. And yet the Fed is lowering rates. It's kind of like having your cake and eating it, too. Can that continue?
Well, I think this is a good question because one thing that the market has refocused on, and I think it's a right to do so, is the inflation story, which I think, a few months ago we thought we didn't need to worry about that anymore. But when we look at what could impact inflation, we've had these storms that we've had that's an inflationary impact when you see things like insurance prices going up, cars needing to be replaced, more building materials, et cetera. China stimulating its economy could ultimately be inflationary. China has been basically exporting deflation. We have both presidential candidates talking about inflationary policies that they'd like to put forth. And the economy has just held up so well that could also serve to limit further improvement in inflation. So I think that's going to be an ongoing debate. And I think we've seen a lot of volatility in interest rates this year in terms of what the bond market's been pricing in. And I don't expect that to go away. Given the environment for inflation now, which seems like we might end up not getting to the Federal Reserve's target of 2%. But in our view, even if it's 3% and the economy is still healthy, I think that will probably still be okay.
But that's with the assumption that the Fed will stop lowering rates sooner maybe than the markets are expecting. You think that's okay?
I think the Fed is not going to stop lowering, but just go slower than the market probably expects, because we are absolutely still seeing some parts of the economy that really are being impacted by higher interest rates. I mean, in the Silicon Valley where I am, certainly venture capital and private equity are absolutely being negatively impacted by the higher interest rate environment. The housing market also could be at risk if we really have not seen mortgage rates come down much at all because long-term interest rates have risen since the Fed lowered interest rates. So I think it's a balancing act. But so far, I think the good news in our mind is that we've seen the peak for this cycle, we believe, in short-term interest rates. So at the margin, they will be coming down.
Hey, Brenda, you own a lot of big mega cap names, but you're not overweight tech versus the broader S&P 500 overall.
We aren't. And I think on the one hand, these stocks, many of them are expensive relative to history. You could argue, well, that's justified because they've been driving so much of the earnings growth that we've seen for the S&P 500. But I think we're seeing an important shift happen. And that is that these companies, historically, many of them have been CapEx light business models. And Wall Street loves CapEx light business models, is usually willing to apply a pretty rich multiple to pay for that. But many of these companies have been spending significantly this year and have become CapEx heavy business models. So we think that's an important change. We saw last quarter that investors really started to question, when are we going to see some returns on these investments? And in some cases, some companies are seeing the returns. Companies like a Meta is definitely seeing return on their AI investments with more engagement, more monetization of the digital ads there, and we think they're going to continue to benefit. But others like a Microsoft and an Alphabet, I think you're still a question mark over when they're really going to start to see a return on some of these investments. So I think if we do enter a prolonged cycle where companies need to spend in order just to stay to solidify their position within the marketplace, I think investors may start to award a lower multiple for some of these companies.